Good afternoon, everybody, and welcome to today's webinar on the outlook for small and emerging manager programs in real estate investing. We're bringing this to you live from the Yale International Center for Finance in partnership with the Yale Alumni Real Estate Association. The International Center for Finance provides an academic and professional support for the research in financial economics in order to foster a greater understanding, practice, and management of finance from an international perspective. The Yale Alumni Real Estate Association is a national association of Yale alumni who share an interest, whether it be professional or personal, in commercial real estate, investments, and management. The ICF is partnered with Yale Alumni Real Estate Association to host a series of webinars on topics of interest to the commercial real estate industry, and today's discussion is the second in that series. Today, we are so pleased to be joined by a panel of distinguished practitioners and colleagues in the small and emerging manager space. We have Peter Braffman of Grosvenor Capital Management. We have Anar Shudgar of Artemis Real Estate Partners. We have Larissa Herzeg of Oak Street Real Estate Capital, and Eddie Lewis of University of Texas Investment Management Company, aka UTIMCO. Our panel today will discuss the risks and returns of the Emerging Manager Program in the institutional investment space, and also hopefully provide us with insight as to the future of SEMs. My esteemed colleagues' bios are listed in the event website. In case you haven't read this, seen it, I recommend that the audience read this. I'm afraid if I had to read it, it would be too lengthy for this 1-hour program. So before we start, if you have any questions, please type in your question using the Q&A button below your screen at any time. We will try to cover as many of these questions as we can at the end of the presentation. So without further ado, let's get started. After a decade or more of low interest rates in the bond markets, institutional investors have poured a lot of money into alternative investments to make up for these returns. And they've done this in hedge funds, private equity, real assets, and real estate, resulting in the increase of smaller and more diverse, and some say more nimble investment managers, sometimes known as small and emerging managers or SEMs. The broad definition of SEM is that these firms that feature specialized and or localized strategies and presumably higher yield to investors, and or firms that are led by women or minority-owned companies, which allow investors to address mandates towards diversity, equity, and inclusion policies. So I'd like to start with you, Peter. As one of the leading firms in the SEM field, Grosvenor invests in SEM across asset classes, PE, real estate, infrastructure, and alternatives. If you wouldn't mind laying out the landscape and walking us through the emerging manager universe. What is the accepted definition of SEM? How did it come about? What type of firms make up the SEM universe today? What sectors and strategies do they employ? And how do institutional investors view and access these programs today? Go ahead, Peter. Thank you.
Thanks, Sherry. And thank you, everyone, for having me and everyone else here. This is great. We love talking about this. So we're going to walk through a little bit of a presentation and give you a sense of this universe. And on page 3, I always like to start out with just what it is we mean by small and emerging managers. It's kind of a definition that's interesting. I was about to say it evolved over time. It really did. It came about and it's kind of stuck. And this is interesting. It's true across multiple asset types, and maybe that's where it starts. It's really started with AUM, and AUM is kind of a universal definition. And it's not a small number; it's $2 billion, and that's generally true for all assets. It's certainly true for real estate, and that just means, and it's usually AUM is defined by institutional capital that's managed by a manager. So if you have less than $2 billion, you could qualify. but we've come up with as an industry other definitions or other constraints as well. If someone has less than 3 funds or on their 3rd fund, they're still qualify as an emerging manager. And the fund size is less than $1 billion, they still qualify as an emerging manager. I would say though that when we start talking about the universe, which we will in a little bit, the vast majority of groups that fall into these categories are way below all these definitions. They are AUM that's in the hundreds of millions or less, or sometimes nothing. They haven't raised a fund yet. It's very few that really get to these levels, and once they get close to these levels, usually they don't. They start not really needing emerging manager capital, quite frankly. So that's the broad definition of what an emerging manager is. It's all these classifications. Diverse emerging manager is just a subset. It's all the stuff that we just talked about, the same definitions, but it's then a question of ownership. Who owns the company? And usually that ownership is defined as anywhere between as low as 25% and as high as 51% ownership. Sometimes these definitions, by the way, are legislatively driven, and different states have different policies on this stuff. So some states require 51% ownership of a company to be considered diverse. Most do not. And we kind of look at it as a question of what's a meaningful ownership and who has control of a company. And usually at some stake, it's too low. And some stake, we like to see a couple of people own the company. So that's why you find some variations. And then the question is like, what's the classification? You see the different classifications there. It's race, it's gender, and it continues to expand over time. All right, so this is the definition of an emerging manager, emerging diverse manager. If we turn the page, we could talk just very briefly about the history. Something to remember about our sector, and not just real estate, but really I think about alternative investments. Prior to 1992, you didn't see much of alternatives. Like it was a small part of the investable market. Less than 2 or 3% of institutional capital went into alternatives. To Sherry's point, interest rates were a big driver of that. There were a couple of other drivers, including pension reform that drove a lot of capital into this sector. But those things, and certainly interest rates, were a big driver for all of a sudden a whole bunch of capital going into the sector. And for real estate, it was also the RTC and the savings and loan crisis that really was kind of fuel on this. And an institution or industry was born. So if you think about that, 1992, at least for me, that's not that long ago. So this asset class in many ways is emerging. The emerging manager programs really began a decade later. So starting in the 2000s, 2003, 4 were really when the first program started. That's when those definitions were created. And since then, you can see over time, a number of programs have come about. It's not small. So we see 52 different programs out there. We see, that a lot of them are smaller groups. They have groups that are, 50 billion or less that have these programs. Usually they cover more than one asset type. And you can see the percentage of groups that invest in different assets. So private equity has the most in terms of emerging manager programs, but real estate is a pretty close second. And you find the others like hedge funds and infrastructure. But a lot of these groups are doing these kinds of things. The other thing I'll point out that's actually important is you see 28 programs publish their content. So we do a lot in emerging managers over here. And it's remarkable how hard it was for us to find this information. It's kind of funny. You would think that a lot of groups would publish that they're doing emerging manager programs or not. So for an emerging manager to navigate this landscape and find the programs, it's not easy. If you go to the next page, you'll see where these programs are located. And I point this out, although it looks pretty well diversified, it's really 4 states that comprise 95% of the capital. That's New York, Illinois, Texas, and California. It's funny. The other states, or some other states are trying to get more involved, but that's where most of the capital is. And as many, even though there's 62 programs, I would say that 6 or 7 plans, like pension plans, comprise over 90% of the capital. So it's really it's concentrated. That's just the reality of it. But it doesn't mean that that the other programs are not impactful. They're incredibly impactful because we're talking about a lot of capital, and therefore getting around and navigating a lot of these programs and getting capital from many of them really adds up. So long way to go. Well, enough said. All right, if we turn to the next page, I could give you a little bit of an idea of the universe. So we've been tracking this since about 2010. We see a whole bunch of managers. A lot of my colleagues on the call have traveled this universe with me. So they know this, they've seen a lot of these groups. And what you'll see is, since over the past 11 years, a little over 1,100 different groups or business plans have entered the market. Doesn't mean they're all successful, but that's how many. So quite a bit. There are probably more, but we think this is a pretty comprehensive number of what's out there. If you see it in terms of what they're doing, about a third of them, a little bit less, are diversified managers. That means and that you can see in the bar charts on the left. They'll do a couple of different asset types. They'll do office, they'll do multi, they'll do industrial, they do a few different things. But the rest, over 2/3 of that universe, are sector specialists. They focus on one thing. That's different than the non-emerging manager universe. The non-emerging manager universe are much bigger AUM players. They're established managers. They manage a lot of capital, and they're highly diversified. They tend to do 2, 3, 4, multiple asset types. So the sector specialists are more in the emerging manager camp. It makes sense. More focused, earlier stage groups, focus in specific markets and specific asset types. Where they come from, you can see in the pie chart on the right. They about a third, a little over a third, are mature emerging managers. By that I mean they are in Fund 2 or Fund 3. Everyone else, first-time funds or before, they're either spin-out teams that come from larger firms, local operators who work with larger firms, and then there are a few non-institutional funds. I would say the most vibrant category are the spin-outs and the local operators. You just see a whole bunch of teams spinning out, and this is true of our business. Alternatives is about apprenticeship, and it's about people getting skills and then people leaving firms and starting their own firms. And we could trace it back, and you can see it's almost like a big bang. You start with a few firms, and all these groups kind of come about as teams spin out and start their own place. That's very prevalent in the private equity universe. It's also true in real estate. And the rest in real estate, what's unique to that are the local operators. There are a whole bunch of them. They operate in certain markets. Usually they're captive capital to large institutional managers. And they go out and say, eventually, hey, maybe I could raise my own discretionary capital. All right. So if we turn to the next page, it's going to look almost the same. It's almost like if you blinked, you didn't notice there was a change. This is a diverse real estate emerging manager universe. And interestingly enough, it really does look the same. It didn't when we first started this, but over time, once you get to certain numbers, it's interesting how it all kind of converges onto a certain kind of universe. And so this universe looks like the broader emerging manager universe. About a third are diversified funds, the rest are sector specialists, almost all in the same proportions as the broader emerging manager universe. You have a few more spin-out teams here than you did before on broader universe, a few less local operators, but everything else is pretty much the same. If you turn the page and you break it down a little bit further, now you start to see a little bit more diversion. Here we broke it up among different sectors. And you can see, and by the way, interestingly enough, what we didn't include in this, it's pretty well diversified in terms of race, ethnicity, or gender in terms of the breakdown across the diverse manager universe. So probably a few more women funds than the rest, and the rest are relatively equal. So it's kind of interesting. So it's good diversification. But if you look at each segment, you break it
Peter,
down. Yeah.
To be clear, when you make the distinction between the emerging manager versus real estate diverse, you're talking about, when you talk about real estate diverse manager, you're talking about those firms that are led by women or minority owned non-white businesses. Is that correct?
That's correct. Yeah, that's correct. And led and to the point before, owned by. So it's not only that they run them, but they own. They could be founders. They own a piece of the management company, at least 25% or up to 51%.
And
Or more.
control the
Control. That's the key.
strategy.
It's really,
Operations.
for now, the way these definitions have developed and the way it's been focused on is that it's about control and ownership and not being an employee. So what the whole focus on diverse emerging managers to date has been, really about, you know, I guess it is diversity inclusion. It is about ownership, and it's about wealth creation, quite frankly. And that only happens through ownership. But thank you, Sherry, for the clarification. Anyway, the point on this page is just to show, really, just as you get more granular, you do start to see more distinctions. Why this is the case, it's hard to tell. Interestingly enough, almost the same across every classification. You find diversifieds are roughly a third of the universe, but after that, it really starts to vary. And a lot of that becomes, again, to what I said before about apprenticeship. Where do people get their training? What have they done before? What's their track record in? And then that starts to define what the landscape looks like in terms of future firms and future ownership.
It's really noteworthy that the multifamily sector has a much greater ownership in the Asian and Hispanic, and the debt field is virtually controlled by African American firms in this space.
Yeah, it's again, if you look at a lot of the financial institutions, and although it looks a little small with respect to women-led funds, actually that number used to be very different. A lot of the investment banks, a lot of financial firms have African American women-led credit departments, and that translates into more diverse, that kind of ownership in terms of managers, and it's different on the multifamily sector. So again, it really comes down to distribution. It comes down to where people are working and how those fields are evolving.
Or their access to those deals too.
Well, that's
right?
exactly right. Yeah, and a lot of it is about access, but it starts with access to employment and starts to access with training. Okay, we could turn to the next page. Briefly, just want to give you an idea about fundraising to date. So we've been tracking this for a while. And what we have found over time is about 34% of the groups that have been out there have reached the final close, about a third. And then another 10% or so, 9 to 10% on their first close. So you say to yourself, well, that doesn't sound so bad. Maybe it sounds bad, but trust me, for raising capital in this market's hard. So that sounds not terrible. The truth is, though, that's overly weighted towards second and third time funds. Second and third time funds, which qualify as emerging managers, have a lot greater ability to raise capital. So if you turn to the next page, you'll see the problem. So what we did over here is just track how often first and second time funds, or first time funds, raise money relative to everybody else. And if you look since 2003, only 15% of the first time funds raised, capital. If you look since 2016, it's down to 9%. So what this is the truth about alternative investing. It's a sticky business if you're a GP. And by that, I mean LPs, if you prove yourself, stay with you. That means that new GPs trying to come into the market have a hard time. And so, and it's becoming even more pronounced over time. So new entrants into the market, first-time funds, increasingly have a very hard time getting traction. Once they get traction and become a second-time fund, third-time fund, it's much easier. They really start moving. But getting access is hard, and that's why these emerging manager programs exist. Now, why, I'll finish up with this and turn it over to everybody else, but why should, or what's the case for investing in emerging managers? There are lots of cases. But one case that always comes up is, well, there's always a question, what about performance? Well, the good news is on performance, it's actually really strong. So if you can turn to the last page, we'll see this. What we've been doing is, and we've been doing this now every year for about 6 or 7 years, tracking performance of emerging managers. And these are not just the groups that we invested with. These are groups that we talk with out in the market. There's a lot of them, a couple of hundred that report yearly. And we just track their performance by vintage year, which is the right way to do it, I think, and compare that with the probably the best standard out there. The two indices that we like, one's called Burgess and one's called Cambridge. We're using Burgess because that's what we use, but we used Cambridge before as well. So we track them and we compare IRR, multiple, and DPI on an annual basis. And we've done this every year. Emerging managers versus the Burgess. And what you see is incredibly competitive or outperformance in almost every year on an IRR or multiple basis. I'm not a big believer. First of all, you can't, you're not going to have constant outperformance. You shouldn't have it. Doesn't make sense. I just like to see competitive performance. But when you see year after year, 6 out of 7 years, 7 out of 8 years, 8 out of 9 years outperformance, it's a trend, and it's an important trend. And it's important to keep measuring this every year because every year these numbers change. Because as many of you know on this call, we're talking about returns. Not all of these are realized. So you have to see how these play out over time. But if you do this year over year and you start to see this kind of outperformance, it tells you something. There's a lot of reasons for it. We could get into in the discussion, but it's a great trend, and it just gives a lot of credibility among all the other important reasons for investing in the space and bringing this talent into the market, that you're also going to get great performance by doing it. All right, Sherry, with that, I'm going to stop, I think.
Great, that's a terrific foundation for this, and a good segue for me to ask the large institutional investor in this on this program, Eddie. I'm going to put you on the spot. As a prominent endowment investor in SEMs, I think Texas has had a history of it. Perhaps you can give us a little bit of a background. In your experience, do SEMs offer improved portfolio performance? Why go with SEMs versus, the giant Blackstones and Brookfields of the world? And what types of challenges have you found and benefits to investing in SEMs?
Yeah, sure. Well, thanks, Sherry. And thank you, Peter. I actually learned quite a few things from watching that presentation. I think here at UTIMCO, we do have a bit of a hub and spoke approach when we invest, because we are a nearly $60 billion endowment. We can't invest all of our capital with small emerging managers. We wouldn't be efficient in putting out money. And so we need to go with the Blackstones and Brookfields of the world to be efficient with putting out capital. But we like to layer that on with smaller and more nimble managers, or managers that are coming up in their life cycle. I think you touched on performance, and like Peter pointed out for SEMs in his presentation, our experience is that we have been fortunate that most of our SEMs that we've invested with have been strong performers in our portfolio over time. We do, when we are investing in these partnerships, particularly first-time funds, we recognize that that's not always the case. So we go into these kind of eyes wide open, right? And we believe that there could be more volatility in their outcomes. We believe that they could struggle in deploying capital at an efficient pace while they build the organization. And deployment of capital is important so that you're not paying fees on sort of what I call dead capital, right? That's not being put to productive use. And it's really, it can hurt funds that aren't able to do that. And they have less established relationships in the industry on their own. They sort of broken away from the mothership and they're on their own. I think they start realizing what life is like when you're no longer at Blackstone or Starwood or some of these other groups where there's a significant organization behind you. And so, but when those organizations get it right, we see performance be really strong with these groups. I think you asked about challenges. As far as our portfolio, I think as institutional investors, we ask a lot of our managers. It's not just about performance. When we're looking at emerging managers, it's about building the right team. It's about developing your support and compliance functions. It's about providing reporting. I think all of these things present challenges for new managers as they become institutional fiduciaries of capital, right? So, we are a fiduciary of some very important capital, and we expect the same of those managers. And so there's a lot that needs to go in to an investment with UTIMCO. And the other thing that we really focus on is a lot of these groups are, especially if they're spinouts or the local operators, they were great deal guys at an organization. But now they have to be a deal guy and a CEO. And those are completely different skill sets sometimes, and it presents challenges. And so those are things that we look for, and we want to make sure that those managers can overcome that challenge of being a CEO of an organization and running things on your own and developing people and all of those things that go into it. So why do we, I think you asked about benefits, and really that's, why do we invest with SEMs? Listen, we wouldn't take that risk if we didn't believe it benefited the endowments and the students at the University of Texas or Texas A&M, the people that we support. The performance has been proven out to us. They have the ability, I think, to access kind of the lower middle market of deals much more nimbly. They have hungry teams. They're really wanting to go out and prove themselves. So all of these things have worked to our benefit. The other thing beyond that, we like to think it gives us a longer runway with groups. Most PE firms are really bad at leadership transition at some point in their sort of firm evolution. And you start worrying about that around Fund 5 or so. But if we're able to get in on the ground floor with an SEM, we believe it gives us better alignment from the start, and it gives us longevity that allows us to scale our capital over time as an institutional investor. So those are some benefits that we see at UTIMCO.
You're indicating that some of these large funds may have legacy issues.
Exactly. And I think all of us on the call that have been limited partner investors with organizations, there's very few of them that sort of as the original group becomes more successful, or they become, a little bit later in their careers and they're trying to hand the business off. What does that actually look like? And does that transition happen smoothly? It doesn't always happen smoothly in private equity. That's been our experience. And so we really look for kind of that new crop of talent that we can build that alignment with from the start.
Thank you, Eddie. I mean, that's very helpful, and it lays out, the broader challenges and benefits of this program. And so, we have with us Larissa and as well as Peter, who handle a lot of funds for those 6 or 7 pension funds in those 4 states that have 95% of the capital in the market. I'm going to ask Anar, because Anar, Artemis is unique in that it concentrates its business solely and exclusively in investing in small and emerging manager programs on behalf of those large pension funds, and with a special tilt towards finding diverse managers and operators, if I'm not mistaken. Tell us about your experience and the challenges you face, your investors face, and your managers face in this program, please.
Thanks, Sherry, and thanks. Eddie brought up a really good point in that, I applaud UTIMCO for being forward thinker in that space, because if we didn't have you guys focus on that succession planning or that change, then the real estate industry as a whole wouldn't be changing. The view and the diversity of the industry wouldn't be changing. So I applaud you guys for doing that. As far as Artemis is concerned, we really operate, our focus on the emerging manager space really focuses on working with operating partners. So where we create joint ventures with those operating partners. And so less on the fund side, but more on the operating partner and joint venture side. And the reason we focus on that is we look at the ecosystem of emerging managers, and they have to start somewhere, and everybody can't be a fund. And so, you know, the original thesis of the emerging manager program at Artemis really started with the evolution of providing core plus capital for those emerging operating partners, because groups like Grosvenor and Oak Street were in existence for opportunistic capital. And the reason is, as you look at these emerging manager operating partners, they don't have a ton of fee income. And as Eddie brought up, the focus on really understanding not only how to sustain your organization, how to deploy capital, but when to sell assets. And it's very impactful for some of these emerging manager operating partners, emerging manager funds, is if when you sell, not only are you maybe realizing a profit for your LPs, but you're also losing that operating income to sustain your team. And so
Anna, excuse me, for those who are less familiar with the terms, can you tell us very quickly what the difference is between core plus and opportunistic?
Yeah, sure. That's a great point, Sherry. So when we focus on our emerging manager program, is we're really focused on kind of that 9 to 11 net area of returning assets, or 11 to 13 gross total return for the assets. So we're looking for assets a little bit more stable, a little less, business plan oriented, a little less renovation. More of that renovation and repositioning has been done, just a little bit left, and therefore warrants a little bit less of a return and more stability, and more of the return is coming from cash flow versus
so more income producing, just
more income producing. Exactly. Okay. Yes. So and so as we think about what the challenges are for those groups today, we've noticed, especially in the operating partner space, there are groups that are more in the emerging manager space that are asset class specific, and really what COVID's highlighted is that kind of tale of two cities. Depending on where your focus has been, is your either business is taking off, or it may be a somewhat stalled or challenged, whether if you're an office operator or multifamily operator. And so you've seen that. And so those groups that are more asset class specific, as Peter mentioned in his earlier slides, it's going to be interesting how that plays out. And investors really dictate where capital goes. And so if you're not in one of those asset classes, you're seeing maybe some headwinds that other asset classes aren't seeing. On top of that, really being able to meet investors or broaden their business because of the size of their team, the size of their firm. I think that has been a challenge for groups. And as people are going as investors are looking at their portfolio, and we're looking at their portfolio and really trying to make sure they're solving their problems and solving any issues in their portfolio, there's less of an emphasis on meeting new managers, meeting new groups. And I think that can have ripple effects on the emerging manager space. So we want to make sure these programs like ours are in the market, actively deploying, finding good investments with those operating partners.
Well, and thanks. That's actually very helpful. And it kind of indicates that there's a little bit more work required in the emerging manager space than there would be in more established, larger funds. And this is a good time to ask Larissa, because you have Larissa at Oak Street as a seasoned investor in the space, and you specifically in real estate. You have a very good reputation for leading and shepherding emerging managers through, for on behalf of pension funds who may not necessarily have the type of staff that Eddie has had to deploy towards this space. Can you tell us a little bit about your experience over the years with these real estate operators and how you create effective and successful programs? I mean, what does success look like to you?
Yeah, absolutely. Thank you, Sherry. Yes, so we work with emerging managers in funds and JVs, kind of whatever whatever capital problem they're trying to solve on behalf of a range of institutional investors as well as family offices and everyone in between. And we've been, I've been in this space for 20 years now somehow, since I was 5. And Oak Street was also, an emerging manager itself. So we started the business in 2009 and have grown the business. And so I think, success can mean a lot of different things, and it's really dependent on, what the individual manager sponsor is looking to achieve. So, one thing that I think probably all of us talk with groups about when they come and say, hey, we want to raise a fund is why, right? And like, oh, we want Eddie's capital. Like, why? That is one path, but it is not the only path. And, they're always quite surprised to hear that not only is it a more burdensome path as far as the outputs and deliverables expected, but for all that additional work, you are going to get paid less than if you don't have institutional capital. So, from our perspective, success is having good partnerships, but that means a lot of very different things to different people. So, success for how Artemis defines their success, they were an emerging manager as well, might be very different from how Oak Street is defining their success. And so I think there's a lot of different ways, but certainly I'd say high level, you want, first and foremost, good returns are very helpful to success. I think a very close second, though, that's underestimated in defining success is being a good partner and a good fiduciary. And it is amazing. I think people assume that because their returns are good, they're going to raise money. And I will say we have curtailed many relationships with groups that have had fantastic returns, but we did not think they were really good partners. And, we felt like if we called and asked questions, if we didn't ask the question in exactly the right way, we weren't getting the answer that we were looking for. And just, a lack of transparency and communication. Whereas we have continued relationships with groups whose performance was mediocre, but they were really good partners, and perhaps overcame a lot of challenges. Maybe a global pandemic got thrown in the mix or a GFC. And, so their returns weren't anything to do cartwheels about. But they were really good partners navigating through all that and good stewards of capital. So I think, returns and partnerships, and being a good partner are certainly measurements of success. And obviously I would say to a degree, those two things should tie into growth and firm growth. But again, that's going to mean different things. Some strategies are incredibly scalable. Some strategies are not. So, raising a 5th fund that's $100 million is a tremendous success for a lot of groups. And that might be all they ever want to manage and the largest fund they ever want to manage. Whereas, a Blackstone $100 million fund 5 would probably
just a
be
rounding
a
error
failure.
for Blackstone, right?
Exactly. That would be a failure. But for some, it's a success. So I think it's, you really don't want to compare yourself or your managers to each other because it's not always an apple to an apple.
No, understood. And you've described the challenges and of teaching operators to become fiduciaries as well, which is very important to institutional investors. And Peter, to that end, you've worked with SEMs yourself for almost as long as Larissa has. Tell us about, how have you seen this investment space evolve? What are the trends that you see investing impacting both the general partners or the investors and the limited partners or the operators in this current environment? And how do you think those trends will move the industry going forward?
Yeah, it's a great question.
It's a lot of questions,
it's
sorry.
a lot, yeah, I know. You got me like,
You can answer all or some, it doesn't matter.
All right, I'll do the best I can with that because it's actually, to me, an awesome topic. it goes back to something I said before, and Sherry, you and I talked about this. Our business is, in many ways, it's still relatively new, but it's also maturing. And so if you think about what's happened, it all starts with the capital. I hate to say that, but that's really true. The engine in this business has been retirement capital, that is, or endowment capital, that's come into this business to seeking return because the capital markets have gotten very efficient, and so they're looking for excess alpha. And an environment with low interest rates that have gone from, up when I was in, I'll date myself, high school, at 15% down to like almost nothing, maybe up a little bit now, but still nothing. That's a 37-year trend of that capital is searched for this. And as this capital has gone in, that's $60 trillion of capital that's gone into the markets, and of which, think about alternatives. Back in 1994, if you look at institutional capital, maybe 3% of that was in alternatives. Now it's upwards of 27%. It's huge, big change. So,
I just want to broach it. We can point to David Svensson at Yale for that because he was one of the first institutional investors to really expand to the alternative asset class, and successfully so.
Exactly. And so what happened? So first, that as it kind of went in, people didn't know what to do. So they're like, first they went with the groups that were in front of them, the Blackstones of the world, that were very good. And then during the 2000s, there was a great proliferation of managers. I call them like the real second wave of emerging managers. A whole bunch flooded. And if you look at a lot of plans and endowments, what they're doing is over-investing, over-diversifying. And they're just doing, and then this past decade prior to that was a rationalization. And you saw a lot of plans getting much more mature in how they were thinking about deploying capital and saying, you know what, we don't need 100 managers doing this. We need 10, we need 15. And so because all of a sudden they were getting much smarter in their strategy, they were concentrating capital, getting better terms, so forth. So where I'm going with this is what's happened. The GP universe has grown, the LP universe has grown too and become much more sophisticated, smarter, and they're demanding more. And they realize that, you know what, we put a lot of these firms in business, and now we're just fighting for allocation. So when it comes to emerging managers, a lot of plans are saying, look, and it follows on to what Larissa said. What's success? Success is finding new teams to grow with, but getting a very different kind of relationship with them, where we can work with them not just in the funds, but work with them directly on principal transactions, direct deals, and get
You're talking about joint venture partnerships, right?
Joint venture partnerships.
Okay.
If you look at most institutional capital, once they get to a certain size of AUM, a lot of their capital is not focused on funds. I mean, a lot is focused on joint ventures, increasingly so, or co-invests, deals that come off funds, where you can extract fee terms that are better, and a very different kind of economic arrangement with your operating partner or with your GP. And increasingly that's happening. You're forming more and more strategic partnerships saying, you know what, with this GP, let's do a series of things. We'll invest in a couple of different strategies with you, and we'll invest in joint ventures with you. And so when we think about what we want to manufacture on these emerging manager programs, it's perfect that you had Anar and Larissa, myself, and Eddie, because in a sense, we represent that spectrum of stuff that's being manufactured. And it's kind of all those stuff. And the GPs that are going to win, are going to do well, are going to become great partners to these LPs, and they're going to provide a suite of opportunities to these LPs, and the LPs are going to provide capital for them to do multiple things. So that's where I think this is going. I could talk for another 3 hours, and everyone on the call knows that, so I won't.
And Electra tells me that, I can't let you speak for that long, even though, I'd love to talk with you over coffee about this forever. But I'm going to open up the discussion to all of you now because of our constrained time. You've touched on, Peter, you touched on what do LPs and GPs expect? What should they expect in this new age when they do an institutional fundraise? How has COVID changed that? Do they have expectations on being good with tech, video, on their presentations? Can you all talk about that from your experience? Don't be shy. Go ahead. Unmute.
I'll kick us off. You know, I don't know whether to love the frugalness or hate the managers who have the free Zoom accounts that expire after 45 minutes. Definitely, I appreciate the penny pinching, but it's super annoying to get kicked off and be like, okay, we'll just dial back in. But no, I think Zoom is great, especially for emerging managers. For us, it does not replace in-person meetings. It does not replace property tours. That's an important part of our diligence, and we're not going to invest without doing those things. But, you know, particularly for groups that by definition are small and don't have a lot of money, Zoom is a great way to get to know investors, you know, and start kind of the dating process without having to hop on a plane and come visit, you know, go to Austin and come to Chicago. And so, you know, I think the technological aspects of it are really, it's a big positive for the pandemic. Frankly, you don't need office space at the moment. So that's, you know, again, another huge line item you can save as you're starting your business. Of course, long-term, we do expect to see an office at some point. But I would say all told, I think technology is, you know, any new manager's friend, and the more you can leverage technology efficiently, the better off you're going to be long-term.
How about you, Eddie? What do you think?
Yeah, I agree with everything Larissa said, but I will put this caveat because I've done now so many Zoom calls that I've realized myself what I'm capable of and what I'm not capable of on Zoom calls. So I think for first-time meetings, they actually may stick. So post-COVID, first-time meetings, a lot more of them may be on Zoom or Teams or whatever platform there is. And so we can prepare for that. Now, second and third and diligence, that's all going to be in person, but the first ones could be on Zoom. My attention span on Zoom, if I'm not an active participant like this one, is about 30 minutes or less. I'll just be honest with you. If we hit the 35, 45 minute, you know, and you see my video go off, it may not have been an accident. but I always tell people, like, get your important message across in the first 15 or 20 minutes. Give me an 8-page presentation, right? And in that 8-page presentation, you elaborate on all the key points. Everything else goes in the appendix. And so that way, while you've got the majority of my team's attention, you're hitting the things you really want to hit and you want to drive home. And so that would be probably some advice I'd give in kind of this post COVID Zoom world that we may have for first-time meetings.
I think you hit on a good point, because I think that's a takeaway that everybody should take away, no matter whether you're in Zoom or in person, is really get that message across in that first 30 minutes. Because I will tell you, I've been in numerous meetings that have gone on for an hour plus, where whether I spent 30 minutes with them or 2 hours with them, you weren't engaged because they just kept talking about everything. And I agree, the decks can be super long, and you should be able to tell your story in like 4 to 8 pages.
I hope everybody's listening to this, anybody who wants to access institutional capital.
And I think the only other point that we didn't touch on is transparency. As Larissa had said earlier in the conversation was, you know, COVID and the great pandemic, no one could have predicted. And if you aren't transparent, whether it's COVID cases in your facilities or in your buildings, or whether it's, you know, tenants that are not, paying rent, or as a fiduciary, you expect that transparency, whether it's good or bad. And I think that's a lot of it. There's definitely expectations of that.
Open kimono.
Yeah.
Yeah, and I would say too, it's interesting to see the managers who really like strive to be perfect and never have any issues, never have anyone leave the team and are, kind of want to brush things under the rug, whether they're material or not to hide them from investors, but because they want this perception of perfection. And that's just not realistic, right? No one, aside from those of us on this call, no one's perfect. And so investors don't expect that, so just own your mistakes, and that's how you learn. And frankly, when everything looks too good, you kind of say, I actually they seem too good and they haven't really learned their lessons. They don't have any scars, and I don't want them learning on my watch. So I think that's part of the transparency that you shouldn't be scared of as managers as well.
I totally agree. I mean, some of the best teams we've invested with have had meaningful mistakes. They've learned from them, and they actually almost lead with them and say, look, this is what we figured out. It's great. And the other, I'm sorry, Sharon.
Go ahead, please.
You sure? All right. So very quickly, the other thing I'd add on this kind of correlates to this topic is, look, to the extent there are managers on this call or would-be managers on the call, when you're talking with LPs, it's just an extraordinary opportunity to demonstrate your excellence and what you're seeing out there in the marketplace. We see, literally, we have hundreds, 500-600 meetings a year. So, and we see every asset type. So you should imagine that we've seen the charts before, we've seen the data, but everyone knows the market in the way they can define their box, in a way that no one else can. And I like to be able to say that after a meeting, if I could come out of that meeting and say, you know what, they just taught me something that I just didn't know. Or, when I'm driving down the street and I see a building, I'll be like, that's a building that group would buy. Because I get it. I get what they're looking for. That's the opportunity. That's what really should come out in these meetings. It should be very substantive and make it blindingly obvious what the opportunity is.
Terrific. And I've got a few more minutes before Q&A. I just wanted to throw out one last thing out there. In the wake of George Floyd and the Black Lives Matter movement, are diversity and inclusion policies among investors a great driver still in this space, or about the same, or less important?
Yeah, I'll very quickly just say more so, for sure. There's a lot more conversation around it, a lot more conversation, a lot more desire among groups I've never seen express desire before, and a lot more seriousness. I still think it's going to take time. But when you see that kind of interest that's pervasive, and conversations are going on now, I think it's meaningful.
I'll only add that I think that means change for the industry, which is a positive, so I think the more discussions that are being had means it's going to evolve into change, and people are willing to kind of realize unconscious bias that they have, and it's not intentional. And so when you have more conversation, enable that change.
Eddie,
Sure.
Larissa?
Yeah, so I guess from the UTIMCO side, it's funny. I think for us, we set up a diversity and inclusion council in 2019, which I co-lead with the head of HR and then one of our talented women investors in our public equities portfolio. But I think we've spent a lot of 2020 understanding our approach internally at UTIMCO around creating access to the investment management industry, opportunities for career success, education and awareness, and then ultimately becoming a leader in our local community. Because I think what we realize is that you have to educate in areas where this industry is just unknown to people. We also sort of know this idea that sort of talent is universal, but opportunity is not. And so we're really focused on creating that. And but as we get those policies set internally, I've already been telling many of the managers that we meet with, hey, we're going to hold ourselves to a standard of excellence here. We're going to hold you to a standard of excellence. And it doesn't matter if you manage $25 million or $25 billion. There's going to be an expectation if you want our capital that if you look at the faces of the leaders of the industry on this call, that this is what we expect from you as well, right? We expect you to be leaders. And so that's going to be the Utimco approach. I think that's going to be everybody's approach.
Excellent. Larissa?
Great, agreed. You know, it's always, we're a woman and minority owned firm, both ownership wise and team wise. And so it's always been important to us. We've always demanded kind of diversity and PRI policies of our managers. But I do think you're seeing it more and more and more, which is fantastic.
Great. I'm going to launch right into a couple of questions here. And I think this one's specific to you, Larissa, from Shepard Siegel, and who thanks us for taking the time to make this available. He's curious as if the SEMs that grow out of this category, in other words, graduate to the next level, no longer small emerging, if that success leads to the LPs throwing money at the now proven team and strategy and the end of evolving to average returns as opposed to, you know, losing their mojo of being nimble?
Yeah, it's a great question. So obviously, certainly the hope is that, you know, larger LPs do start investing directly and there is kind of that transition. And I will say that is a key challenge of, you know, kind of small and emerging managers evolving is you don't want to lose your mojo. And so as you scale your firm, you need to make sure you're sticking to your knitting and staying true to why you've been successful. And that sounds super easy, but it's incredibly challenging, both to execute, and it's incredibly challenging to do in the face of people wanting to give you money and you really having to reflect on, can we take all this money? Because after struggling so long, you know, to raise that capital, the last thing you want to do is say no. But I do think you have to be very thoughtful about why you've achieved the success you have and how the scale is going to impact that. So it's a great, very thoughtful question.
Thank you. And I'm going to end with, I have one more question here. And if there are any more questions, please email them to us and we'll try to answer them via email as well. But this one's from Julia Hyman. Peter, how much was raised by the first-time funds in 2020? And do you have an estimate for first-time funds for 2021 year to date so far?
Yeah, 2020 was an aberration, so it's hard because capital raising was not terrible, but because of COVID, a little off. So it was 70 billion at least in 2019 for total capital raised. Last I checked, I think on the chart we're showing 20 billion. It's really close to 35 billion of capital raised across the board for emerging first-time funds in 2020. I mean, you know, less than $1 billion. But I think 2021, there's a lot of marketing going on. 2021 will probably be a more normal year, and we're going to see it back up into the $5 to $10 billion range. So it's going to be meaningful. And I'll just add very quickly, because Larissa made a great point. This is an interesting question about as groups scale up, what happens. It's hard. Incentive fees, if you think about a fund economics, half of a fund's revenue comes from asset management fees. The other half comes from incentive fees. But the probability of incentive fees working out, you know, you have
You're talking about promotes, right?
Promotes, yeah, I'm talking about promotes. So what happens when a group gets much bigger, the AUM, you know, the probability of getting returns on their asset management fees are high, not on promote. And so inevitably they're going to be incentivized to get more AUM. It's very hard. So it's a tough balance.
It's tough all around, but I'm getting the hook here. So I just want to thank all of our participants here for joining us today and sharing your knowledge and your experiences. To the audience, we hope you can join us. We will try to answer questions via email if you email them to Yale. We hope you can join us for the next webinar in our series to be announced soon. Please check Yale ICF's website for this. And please take care of yourselves and each other. Thank you so much, everybody.
Thank you, Sherry.